Hi dear students, this is CAT course offered by St. George's College, Arvitra. This is paper 1, Fundamentals of Financial Accounting, video number 6. So today we will be discussing these many topics: events and transactions, vouchers and its types, source documents, the concept of account, debit and credit, types of accounts, accounting process and accounting equation. So let's discuss the first concept, the events and transactions. So we should distinguish between what is an event and a transaction. So let's see what is an accounting event. So accounting event means it is a financial event that will have an impact on the account balances of companies' financial statements. We know which are the financial statements. It may be trading account, profit and loss account and the balance sheet, or it may be the cash flow statements. So an event means anything that is having an impact or that changes the financial values of the financial statements, that is known as an accounting event. So if the balances of your financial statement changes, then we can consider it as an accounting event. And the accounting event can be both internal or external. So the transactions that happen in the business can either be external transaction or an internal transaction. So external transaction means the transaction which a deal or which is occurring between an outsider party. The person may be an outsider, or the transaction that happened between the person, between the business and an outsider is known as an external event, like the purchase or the sale of good. And the internal event means that changes the accounting books of accounts. If it changes our books of accounts or our accounting records internally, then such type of transactions or events are known as internal events. So if it is between the business and an outsider, that is an external event, and if it is inside the business itself, and then that is known as an internal event. Now let's see what is a transaction. So we can say that the events, all the events may not be a transaction. An event can be classified as a transaction if there is a monetary value. So there can be many events which is happening in a business, but all the events cannot be treated as a transaction. It can be treated as a transaction if the event is supported by a monetary value. So this is the basic difference between an transaction and an event. So all the transactions are treated as events because that can either result in a monetary value, or it may not be resulting in a monetary value. But all the events cannot be considered as transaction because there is a criteria that should result in a monetary event. Then only the events can be treated as transactions. Now we are moving to the next concept, that is a voucher. We have already said that to record the transactions into the books of account, there need to have a documentary proof, and one of the documentary proof is considered as a voucher. So let's see what is a voucher. Voucher is a written instrument which confirms a particular transaction. So whenever a transaction happens, there should be a documentary proof. It is for the verification. It is for an authentication. So it's a written instrument, and what it does, it confirms a particular transaction. So it confirms that the transaction has already taken place for this particular value on a particular date, and that evidence is shown in a voucher. So commonly a voucher is a document that shows goods have bought or the services has been rendered, and it authorizes the payment, and it indicates which ledger account is to be recorded. So many things are being identified from a voucher, like what is the amount of payment, which all parties are involved in that particular transaction, how much amount of goods has been sold, or how much amount of goods has been purchased. All these things are recorded in the voucher. Now let's see what are the different types of vouchers. There are 4 different types of vouchers, like receipt voucher, payment voucher, non-cash or just a transferring voucher, or a supporting voucher. So we know what is the concept of receipt. We have received the goods, we have received the money. Likewise, the receipts are recorded in the receipt voucher, especially the cash receipts and the bank receipts. So cash receipt voucher, it records the receipt of the items that is received in cash, and the bank receipt voucher, it records the transactions which involve check or demand draft. So it will be recorded separately. If it involves a cash value received in the form of cash, that will be recorded in cash receipt voucher. And if you are either receiving a check or a demand draft, so such wise transactions are recorded in the bank receipt voucher. And the opposite of receipt is the payment, which means the cash is moving out or your bank accounts are being affected. Such type of transactions are known as payment voucher. You are paying it in the form of money, or you are paying it in the form of check or demand draft. Then such type of transactions are known as payment vouchers. And here also it can be cash payment voucher or the bank payment voucher. As you already know, if it is paid in the form of cash, it will be supported by cash payment voucher. And if the payment is done with the help of check or demand draft, then it will be supported by the bank payment voucher. So that is the first type of voucher, the receipt voucher and the payment vouchers. The next one is non-cash transactions, which means there can be sometimes the sale or transfer of goods without the actual receipt or without the actual payment received. So such type of transactions are being recorded in non-cash or transfer vouchers. Here that the money value is not at all received, but the transaction has already happened. So such type of transactions are recorded in non-cash vouchers. So this is a documentary evidence recording non-cash transactions. You can see an example: goods sent on credit. Here the actual sale has happened, but the money is not received, so it cannot be recorded in a cash receipt or a bank receipt voucher. So what we are doing, it is being recorded in a non-cash voucher. And the last one is supporting vouchers. So these are the documentary proofs in support of a particular transaction. So that is the documentary evidence. So sometimes we may not get a receipt for a small amount of value. It may not be, you may not be receiving any receipt. So at that time we will be using supporting vouchers. So anyway, whatever transactions happen in a business, it should be supported by a documentary proof. Now we are moving to the next concept, that is source documents. So whenever we are recording the transactions, it is mandate that there should be a supporting document, that is the evidence of the transaction or the proof of the transaction. Such type of documents are known as the source document, the supporting document, or the proof document, we will say. Okay, the source documents are the basis on which the transactions are being recorded into the subsidiary books. So the subsidiary books can be either cash book, purchases book, sales book, or the return inward, purchases return, or the return outwards. Okay, so such type of books are known as the subsidiary books. Okay, so what is the documentary or the source document in support of a cash book? It can be either cash memo or cash receipt or the issue vouchers, etc. So we need to just know about which are the source documents supporting to that particular book. Next one is the purchases book. The purchases book, it can be inward invoice or the credit transactions that happen in support of that particular goods. And what about the sales book? It is outward invoice issued by the debtors. And return inwards, that is the sales returns, that is the credit note. And return outwards, the purchases return, that is the debit note. So these are the source document in support of this subsidiary book. For cash book, it is cash memo. For purchases book, it is inward invoice. For sales book, it is outward invoice. For return inwards, it is credit note. And for return outwards, it is debit note. So these are the documentary proof in support of your subsidiary books. So the next concept is the concept of account and debit and credit. So let's see what do you mean by an account. Account means it is a summarized record of all the transactions that happen in a particular business. So we can say that it is a summary book. The account is known as a summary book, which means we know there are a lot of transactions happen in a business, but it may not be, all the transaction may not be homogeneous, or it may not involve the same type of elements. So all the elements which is having a common nature is grouped together, and that grouping and that summarizing is known as an account. So the account is related with both tangible and intangible items like land, building, equipment, etc. These are tangible, and intangible like any brand value or trademark, etc. So the common nature, they are summarized together, and that summary is known as an account. An account takes the form of an English letter T. The account looks like English letter T, and this account is having two sides, and one side is known as the debit side, and it is the left hand side, and our right hand side is known as our credit side. So that is the common out view of an account. Account looks like the English letter T, which means T is having two sides, right? A left hand side and a right hand side, and the left hand side is our debit side, and the right hand side is the credit side. And the short form of debit is DR, and the credit is CR. So that is already known to you. Now let's discuss about what are the different types of accounts. The accounts are generally classified into two: personal accounts and impersonal accounts. And the personal accounts are further classified into three, and that is natural person, artificial person, and representative person. And impersonal accounts are classified into two: real accounts and nominal accounts. We should clearly know what are the classifications, because on the basis of these accounts we are deriving the basic equation for the transactions. So we should know personal and impersonal accounts in very detail. So let's see what is a personal accounts. So the personal account means these are related with the persons. Okay, as the name itself suggests, it is person, it is related with, or the transactions or the accounts are related with the persons. And we have already seen that the personal accounts are divided into or classified into three. The first one is natural personal accounts. Okay, natural person means you can clearly identify your name. Your name is a natural person, like Suresh account, Anil's account, Rani's account. The name of the person, that is a natural person. Now let's see what is an artificial person. Here the artificial persons are classified as the companies or body corporate, etc. like Videocon Industries or the Infosys company, etc. So these are artificial person. And there are certain representative personal account like outstanding accounts, which means the amount is to be paid, but it is actually not paid by the company. It is yet to be paid. Then the amounts will be recorded in another account, that is outstanding accounts. Such type of accounts are known as representative personal accounts, which means the account represents to a particular person and the amount will be paid only in a future time period. Such type of accounts are known as representative personal accounts. So personal accounts classified into three: natural person, artificial person, and representative person. Natural person means the name of individuals like Suresh, Anil, Rani, etc. Artificial person, the name of the companies like Infosys, Videocon, etc. And representative person means certain outstanding account like salary payable account, rent payable account, interest payable account. Such type of accounts comes under representative personal accounts. The second classification, impersonal accounts. Impersonal account, the first one is real accounts. Real account means those accounts which represents the real items which we can see, touch and feel, especially relating to our fixed assets. So such type of accounts are known as real accounts, which is having a physical existence. So there are two classifications of real accounts: tangible and intangible. So you know very much about the examples of tangible accounts like machinery account, stock account, cash account, vehicle account. These all comes as tangible assets. And intangible assets like goodwill, patents, trademark, copyright, these all are intangible accounts. So such type of accounts are known as real accounts. In one word we can say these are assets of the business which is having a physical existence and which is not having a physical existence. Physical existence means real account, real tangible accounts, and if it is not having a physical existence, intangible real accounts. Now coming to the last impersonal account, that is nominal account. The nominal account represents all expenses and incomes. So this is an account which shows all the expenses or which represents all expenses and incomes like rent, taxes, traveling expense, wages, salaries, loss by fire. So which means some of these are expenses, some of these are incomes. So these accounts comes under the category nominal account. So these are types of accounts: personal, impersonal. Impersonal, we have three classification: natural person, artificial person, representative person. And in impersonal, two classifications: real account and nominal accounts. Now we are moving to the accounting process. We are approaching to the end of this particular video. Let's see what are the accounting process. There are basically two different approaches for determining the transactions or recording the transactions. First one is the American approach, or it is also known as the modern approach, and this approach is generally now been in existence. And the second one is the British approach or the traditional approach, or we can say it as the double entry system of recording these transactions. So this American approach and British approach, they derive certain rules while we record the transactions into the books of accounting. So let's study what are the rules relating to these two approaches. So first we are moving to the American approach. In American approach, all the transactions that happen in the books of accounts are being classified into 5 different categories. The first one, it may be something relating to capital, liability, asset, incomes, or expenses. So there are 5 different classifications. On the basis of that, we are identifying the transactions and the rules are being applied. Clear? With the 5 classification: capital, liabilities, assets, expenses, and incomes or revenue. So all the transactions come under any of these 5 categories. Now let's see what is the rule. So the first one is capital. We know capital is having credit balance, right? Capitals are having credit balance, which means if it is a capital account, if it is to be increased, then the credit is to be again made, right? So here credit means increase and debit means decrease. Now the second one is liability. We know liability accounts are also having what balance? Credit balance, which means credit means increase and debit means decrease. So that is the rule. So if a liability account is to be created means increased, then we should just credit it. And if a liability account is to be reduced, then what should be done? It should be debited. That's the only thing. Next one, assets. We know assets are having debit balance. So if we want to increase means debit means increase and credit means decrease. Now expenses, we know expenses are having debit balance. Again, to increase a expense we should debit it, and for decreasing it, it should be credited. And for revenue, we know revenues are having credit balances. So here credit means you are increasing the income and debit means we are decreasing the income. So what we need to do here is just study what is the balance for each of the account. Like capital account, it is having a credit balance. Liability account is having a credit balance. Asset account is having a debit balance. Expense account is having a debit balance. And revenue accounts are having credit balance. So the balance says that if the account is to be increased, then that particular balancing is to be done. So capital credit should be done to increase it. Liability credit is to be done to increase it. Asset debit is to be done to increase it. Expenses again debiting is to be done to increase it. And for revenue crediting is to be done to increase it. So that is the American approach. Now let's see the British approach. British approach is entirely different. We have seen in British approach we are considering as three different accounts: personal account, real account and nominal account. So let's see what is the rule relating to personal account. Debit the receiver and credit the giver. So that is the rule relating to the personal account. So if you are receiving it, if another person is receiving it, debit the receiver and credit the giver. For example, you can consider sale of goods. Okay, sale of goods to Ram. So we can say that Ram is receiving the goods. Okay, so who is the person receiving it? Ram. So the Ram account is to be debited and the credit goes to sales. Okay, so that's why Ram account is being debited, because it is a personal account. Ram is receiving it, so debit the receiver and credit the giver. Now let's see the next one, the real accounts. Let's see the rule for real account. Debit what comes in and credit what goes out. Now we know real accounts means these are assets. So you are purchasing a machinery. Example, you are purchasing a machinery and that machinery is for cash. So we know machinery is a real account. So then you apply the rule, debit what comes in. When you purchase the machinery, what is coming in? Machinery is coming in. So what should be debited? The machinery account is to be debited. So debit what comes in and credit what goes out. And the third one is the nominal account. The debit all expenses and credit all income. So very simple rule. For personal, debit the receiver, credit the giver. For real accounts, debit what comes in, credit what goes out. And for nominal account, debit all expenses and losses and credit all incomes and gains. So whichever approach is taken, whether it is an American approach or whether it is a British approach, there will not be any change in the transaction values. Okay, the dealing will be same. There is no difference in the ultimate dealings. Now we are moving to the last topic, that is accounting equation. So we have already discussed what is accounting equation. Accounting equation is equal to assets are equal to liabilities plus capital. So which means this should be balanced always. Such balanced equation is known as accounting equation. So assets will be always equal to liabilities plus capital. So the another name of capital is known as the owner's equity. Okay, so this can be again written as assets are equal to liabilities plus capital. P denotes capital. And how can you write P? P is equal to, then the liabilities will go to the other side. Then we can say that is assets minus the liabilities. Okay, we can say that assets minus liabilities is equal to P. And if you want to take liability, then the owner's equity goes to the other side. Assets minus the owner's equity is equal to, okay, liability. So these are the other ways in which you can rewrite the accounting equations. Okay, so this is accounting equation. Assets is equal to liabilities plus capital or owner's equity. So this is all discussed in this particular section. We have discussed some individual different items that is very much important before dealing with the journals and other proceedings of accounting. So there are some examples given in your textbook relating to all these things. So you should refer those things and be clear about all the concepts discussed till now. Okay, thank you for watching the video. You can meet in the next video.